Hey guys and girls, it looks like we are live. Just give you guys a few minutes a minute or so to hop on board and jump into the live stream. We're going to have fun today with getting questions and answers from you guys. So just wait for everyone to get on board. Hope everyone's having an awesome week and kicking ass with their goals. Got 2 viewers, 3 viewers. Come on, load up. Let's get it. Hey Josh, hope you're doing well. Um, cool. This is going to be a really fun session of Facebook Live today. I want to make it interactive. Last week or 2 weeks ago, when we had Jeremy on, I said to everyone that we would make this week's Facebook Live like a telethon where you guys can call in, ask some questions that you may have, and whatnot. So I'll get into how we can do that shortly, and we'll start getting into this week's live. So I'll start off with some news articles, and then as more people pop online, then we'll get into some calls and answering those questions that you may have. So um, where's my first article here? What should we start the article with? Um, uh, Here we go. This article. This one explains a little bit about the the current state of the rental market out there. So this is an article from on the news, and it says things are going from bad to worse. $160 caravan for rent in remote Queensland sparks debate over living standards. So I've rented some interesting things over the years, but I've never rented out a tent. But let's go on and read this one. A rental listing in remote Queensland has sparked heated debate over acceptable living standards in a rental crisis. A rental listing on a block of land near a remote Queensland town in Tara. So Tara is a town out near Chinchilla and that. Buy, swap and sell group for $160 a week. The first catch over is that the prospective tenant needs to clear the 600-metre long driveway to access the caravan. Once that's done, the landlord promises 2 weeks rent free to clear, but only after the job is done. Just wow. If you guys know where Tara is, I'm talking about the suburb Tara. I'm not talking about a female called Tara, but you know where Tara is. It's way out in the back of Whoop Whoop, and not many people there, and it's a very shanty type place. There's not a lot of building entitlement there. So yeah, $160 a week for this shipping container looking caravan. Crazy, hey, crazy. So with it, one thing I was thinking about today, I was talking to someone, I forget who it was. I actually realised like throughout the country, we actually provide affordable rental accommodation. Like there's less than 7% of properties that are available under $400 a week in the country at the moment, and I'd probably say about 70% of the properties that we manage and we acquire for our clients would fit in that affordable price range. So made me feel good by the fact that we're able to provide that to the market. So Brad says, "G'day from tropical Cairns. Hope you are doing well. Hope everything is safe up there. Obviously, we've got a cyclone coming through, and yeah, we've got a lot of property up there, which will be interesting to see how it fares. And yeah, my team are giving me an update constantly. But for those of you, I can see that we've got more stronger viewers at the moment coming on board. Just a bit about today's Facebook Live. I'm going to do it a bit different. I want it to be interactive. I want it to be with you guys answering your questions. This is our last Facebook Live of the year. We'll be coming back early in 2024. Wow, the year has gone. So I thought I'd make it a bit interactive. I know a lot of you might have goals. You might have goals that you haven't achieved for this year or that you want to achieve. And someone's left a phone here somewhere. Someone's phone's in my room, beeping off, right? So I'm going to be, here answering questions that you have. I've got a list that some of you have put in previously that from Instagram. We did an Instagram post earlier asking for you guys to send us some questions, and I'll be answering some of them. And you guys will give me a buzz. How to call us? We will call you. Basically, what you need to do to participate, just send us a DM on this page. So if you want to ask a question, send a message to the Be Invested page. It has to be the Be Invested page. You might be watching this on Zinger or on Blink. It has to be on the Be Invested page. Send us a message with your number and your question that you're wanting to ask, and my team will call you from a private number sometime throughout the call, throughout the Facebook Live. If you want to put a little list together, and then we can discuss the questions. My team will bring the phone in, and we can do a little live call, and we can do a little telethon with you guys. So I think it'll be fun. So you guys get your questions in, send them via direct message to the Be Invested page. Put your phone number in there. My team will call you from a private number. They'll have a little chat to you, and then they'll bring the phone into me to have a chat with you as well. So I look forward to speaking with a few of you tonight and seeing how I can help you. A lot of people, where the question might be about, your personal position. We won't go into full details, so don't, just make sure you don't identify yourself on the giving us a full name and stuff like that. If you want to just say your first name or something and ask, I want to build a portfolio, I want to get over a finance issue, whatever the question may be, let's make it spicy, and the questions are not off limits. So just ask whatever question you need. Obviously, keep it property related or investing related or whatnot. But let's keep those questions coming through. So I've got a few questions here that we posted earlier, and I'm going to answer them now for you. So Sean asked, would you buy in Cairns or Port Douglas now? The cyclones are going to hit. We don't know where or if the cyclones are going to hit. Opportunistic, great. The thing I like, I'm actually a very big fan of Far North Queensland. I own probably about 20 motels and pubs up there. Very big in the hospitality space there. Hope everyone's going to be well out there. Hope, touch wood, that my properties will be okay out there. From speaking with some of the locals that know information about, the media like to blow out lots of things, but they're saying that once it sort of hits the land, that there's no ocean to drag with it, and it should, dissipate a lot. So I think it's blown up a lot more than what it actually is. One of my favourite properties is one that I bought in the Whitsundays. It's a motel. I'm doing a big reno on it. I actually bought it on the back end of Cyclone Debbie, and this property should bring in over 100% return per annum. That's including the reno. There is opportunities out there within any catastrophe. I don't want to get predatory in nature on that front yet, but there's always going to be an opportunity in any sort of market. So we'll wait and see what happens. But I'm not fearing as much as what the media is coming to us with. So I'm going to get some more articles in between calls and whatnot coming through. I will read some articles. Normally I read all the articles to start off with. So I've got questions coming from you guys on the message chat, like on the message, like the comment box. I'll answer those ones as well. But if you do want to call, as I said, put your mobile number or landline, whatever you use, into the comment section. In the private message, sorry, not the comment section. Put your phone number, a bit about your message into the DM. Send it over to the Be Invested page, and my team will call you and answer some of those questions. So, Luke says here, does a cyclone equal free reno? Possibly. It depends on your insurance policy. I just had one of my investors text me saying, Nick, the team will be in contact shortly. Call 1-800 now. Keep those questions coming through. I had someone just message me beforehand saying that they're trying to get insurance, building insurance for a cyclone. It's like you should have had that insurance in place now. They're not going to insure you on the eve of a cyclone. It's just not how it sort of works. So you do need to be prepared for these things beforehand. It could possibly mean a free reno for you. You just need to look at a part of your policy there. Brent says, thanks Nathan, I'm all calm at Trinity Park at present, Category 2 or possibly Category 3 coming through tomorrow exactly. So we'll see how we go. Brendan says, new haircut, looking sharp. You know what they say about fresh cuts. I'm joking. Just got a haircut, bit of a summer cut, got it nice and short. I'll actually make my haircut shorter over Christmas. I'm hanging out for this reversal. Alboflation is helping us out too as investors. Exactly. It's great. Joe asks, Broken Hill, what are your thoughts? I've never bought there. I don't intend on buying there. The banks don't like to lend out there. It's very, very remote. It is probably too far on the risky side for me. Some people say, oh, you're taking a lot of risks, Birchie, but that buying in Broken Hill, I don't even look at it. It's not something I've ever bought in for me or any of my investors. If there was an opportunity then, I would really knock it back if it was really great. But I think for the prices that they're selling for out there, you can get a lot better value elsewhere in the country. What are some of the other questions here? Jordan says, hey Nate, what if they reset the currency before hyperinflation? Is that a possibility? And if so, how do you see that playing out? A currency will collapse, and I think that we will see that occur once we start seeing rates drop. One of the things, I don't have an article here, but the US Fed meets in 2 days' time. So I've been saying this a fair bit lately, and I'll repeat myself on this one as well because it's very important. People are talking about rates going up or down or whatever. Whatever the news says, whatever the experts say, whatever anyone has to say about interest rates, you can't have the US reducing rates and every other country increasing rates, because otherwise the currencies will crash, the US dollar will crash in comparison, or the Aussie dollar, whichever way that it goes. So they sort of need to go up and down in step with each other. So it's an interesting sort of position, and everyone should be looking at A, the bond markets, and B, the US monetary policy. And I think we'll start seeing over the next couple of months that these rates will start changing and reversing in monetary policy, and that's where we'll start seeing hyperinflation and the collapse of our currency. Shout, can't hear easily. I don't know. I'm talking pretty well into this. What have I got here? Hey mate, I have a principal place of residence and a duplex of 2 units on one title. Would you suggest a house as the next buy or a unit? I don't have a preference whether it's a house, a unit, a townhouse, a villa. Can we get that phone out of here? Yeah, of course. Yeah, it's beautiful. Done. I've been told to be louder here, but I couldn't talk because there was a vibrating phone over there in the room. Looking at, should you buy a house? Should you buy a unit? Should you buy a villa? I don't have that as a preference when buying a property. I'm not out saying, hey, I'm going to buy a house. If I was to buy a property, most people want to see if it's a house, a unit, villa. Right? It doesn't matter. The way I see it is if someone was to give me $50,000, right, and me looking at from a house, a unit, or a villa, if someone gave me 50 grand as 5-cent pieces, 10-cent pieces, $100 note, whatever, it's still 50 grand. So the way I see the property is it's just a vehicle to get you to your end goal. So it doesn't matter if it's a $5 note, a $10 note, a $100 note, digital, whatever, as long as it's achieving that goal. So for me, it's what I'd be looking at is what do you need to do to keep the bank happy in order to get you to the next stage of your goal, get you to the next stage of your journey. And that's what you should be asking yourself when taking on a property. So that's my view on it. So I have someone on a call right now. Thank you for bringing that in. Nick? Okay, beautiful. Nick.
Hello, mate. How are you?
Good. Yourself?
Yeah, good. Thanks, mate. I just want to make sure I've got you on the PC, but I'll mute you and so it doesn't cause any issues.
Yeah, beautiful. I'll put you so everyone can hear. If everyone can hear Nick, maybe just leave us a little message that you can hear him. But thanks for the call, Nick.
No problem. Thanks for the call back.
Pleasure, mate. Pleasure. How can I help you?
Sent through a question. So basically at the moment I've got 8 properties in the portfolio.
Okay.
I'm just going through finance with Zinger at the moment to basically pull out 300K of equity. And I guess my question is, what do I do with that equity? Now, my goal here is to get 200K net passive income.
Yep.
So I guess that's the question. I've got 300K in equity.
Yep.
What's the sort of next step for me there?
Well, this one here's, I'm just going to put a little disclaimer on for everyone, just in case we have some authorities like listening in and saying that I'm giving financial advice. So I just,
Yeah, true.
we're just mates down at the pub having a chat.
Absolutely.
So a little disclaimer, like everyone's position is different. There's probably more questions that I've got for you on this front, but I'll step it down as to like a bit of a generic sort of answer, but yeah, give you some guidance on that. So a couple of questions. Which bank are you refinancing with? Like, are you with a big four bank or just with a...
At the moment, yeah, with Westpac.
Okay, cool. So with the bank perspective there, um, servicing is apparent. Are your properties bringing? How much would your properties be worth in total, roughly? Just roughly.
Probably about 3 mil, I'd say.
3 mil. Okay. Are they bringing positive cash flow at the moment, or neutral, or negative, or?
No, they're probably slightly negative, just given the rates.
Okay, cool. First thing I'd look. So you want to get about 200 grand a year passive.
That's the goal, yeah.
Yeah. Okay. First thing I'd do is to reverse engineer that goal of 200 grand and go, what does that look like on a weekly basis? So 200 grand is 4 grand a week. 4 grand a week, average rent of say $300-400 a week. You're going to need about 10 properties, 12 properties owned outright. And then from that, how do you get 12 properties outright? Let's say the average price is 200 grand a piece. So then I would go, okay, 200 grand times 12, that's $2.4 million. Do we save up that? How do we get those 12 properties? It might be that we buy 20 of them. They double, 200 grand to 400 grand. You sell off 10, pay out 10, like that. Or you could get 20 properties. They go up by $100 a week rent. There's 2 grand a week rent, positive cash flow coming through. If they're neutral cash flow today, you push them up $100. There's 20 of them. And then that'd be like 100 grand a year, so it's halfway there. But I think there's like a bit of a hybrid there. But the question that you would have is, how do you go about getting, you've got 8, which is great. How do we get that to 20, which is just adding an extra 12 in there? So if you're pulling out 300 grand worth of equity, I find the numbers work best with around 150 to 300 grand properties. So with your 300 grand, if you're going 20% deposit, no mortgage insurance, etc. I've got my reasons to why I like that, which I don't want to deviate from your answer and just give you the shortest version of it. You've got sort of 6 deposits there to buy 6 properties straight away.
Yeah.
So you're about a third of the way to your goal of the assets that you require to get there. You're servicing with a big four bank, which is good. I would look at using, if it was me, if you've got, basically you need to keep the bank happy from a cash flow side of things. You can keep working hard at the service at the bank, or you can make sure you've got properties that are giving you positive cash flow to get you there. So in my view, if it was me, I'd be looking at, without giving financial advice, it's just very generic by nature, I would be looking at getting to 20 properties. And then I'd look at, if I had 300 grand and it was 50 grand for a deposit and closing costs, I'd have 6 deposits there. I'd buy 6 more that'll get me from 8 to 14. And then I'd go back in another 6 months' time, buying them below market value and whatnot, pulling out equity in 6 months' time, and then go and buy another 6 properties, and you get 20.
Repeat, yeah.
It's rinse and repeat. That's it. So that's what I'd be looking at. As for locations and that, I wouldn't stick them all in one location.
Yeah, for sure.
Maybe a couple in Perth, a couple in Sydney, a couple in Brisbane, a couple in tropical Queensland. I'm laughing at that because everyone's sending me questions about tropical Queensland at the moment. I think the media's blowing things up a lot worse than what it is. But with
As they usually do.
As they usually do, exactly. But I think you're in a good position. Like 300 grand, like you've got that as equity. It's just using the assets that you've got now to help you get closer to that goal. And you're not going to get, like 8 properties is a good position. But is that enough to take you through retirement? How are you going to pay out the debt? How are you going to turn those neutral cash flow into positive cash flow? If one was to have, say, $5 million worth of debt today and the portfolio was neutral, if the interest rates were to come down, and this is just very hypothetical scenarios, I remember having a chat with one of my staff who has like 3 million worth of debt, and I spoke to this person about 6 years ago when the interest rates came down, and they came down 1%, and I was like, you just saved 30 grand a year, right? And it came down 2% and came down 3%. And I was like, you just saved $90,000 a year. Like that's enough to turn you into, retirement sort of phase. So if they were
Yeah,
mutually,
it's crazy.
yeah,
It's crazy. I can't wait for the rates to come back because it's they go back to 4%. I'm retired from the bank that I work at. So
okay, exactly. And it's, but the good thing about them going up, and I think a lot of people, get caught up in, okay, rates are hurting me today, et cetera,
yeah,
is that you can push the rents up at the moment as well. And I think looking at the bank, like everyone that's got a mortgage should be going back to their bank at least a couple of times a year and just saying, hey, look, they've gone up a fair bit. I'm getting better offers with other banks. Is there anything you can do before I start refinancing them over? Because then you can try and save a few bucks there as well.
yeah, for sure.
Yeah. Cool. Any other questions that you've got for me at the moment, Nick? Or
I'll probably reach out to Wayne, mate. I've had a few chats with him and maybe have a chat with you offline about a couple of other things. But I appreciate the generic information you've given me here. It's been good.
Pleasure. So just in short, just recapping, if I was gifted with 300 grand of equity and I wanted to get there, I'd probably be looking at the next 6 properties, and then from that, try and do the next 6 over the next 12 months. And that's sort of where most of our investors sort of work along is building out a portfolio like that. If you buy 6 at 200 grand a piece, that's really like 1.2 million worth of debt. But if those 6 properties are renting for $400 a week, that's 6 fours are 24. That's 2,400 a week in extra income. It sort of covers the outgoing for you. So.
Yeah, perfect, mate. Awesome. Sounds good. Thanks for the chat.
Pleasure, mate. I'll speak to you soon. Have a good one. Thanks, Nick.
All right, you too, mate.
Thanks for the talk.
Bye.
Bye for now. Thank you. So if you guys want to hop on the phone, send the team a message, a private message with a bit about your question, your phone number, and they will call you from a private number throughout the live, and I'll answer it and give you some answers. On the back of that, I don't know if I read this article to everyone. It just made me think about this article. I've literally got like about 10 articles here in case I didn't have enough calls today. I did talk about this recently. I'm unsure if I did a live on it. It says, why 1% of Aussies are ruining it for everyone? And I was just chatting to one of my staff beforehand, one of my new staff, probably in the last 3 months she's been working with us. And she's like, one thing I find interesting is that you've helped like thousands and thousands of people, build large portfolios and get into the elite 1%. This article came out in the news the other week, and they're calling the 1% of Australians ruining it for everyone. Right? And it says here, despite being used by less than 1.6 million Aussies, or 4.1% of the population, the latest data available, negative gearing is a hotly debated issue and seen by many as a political kryptonite for governments and oppositions alike. One of the key battlegrounds of the negative gearing debate over the past 7 years has been the mind of now Prime Minister Anthony Albanese in an appearance on Channel 9's Today Show in 2016, when then an opposition leader had to say about the impact of negative gearing and capital gains tax discount. We're in danger of developing a society where some people are able to buy their 6th, 7th and 8th home, but people trying to get into the market buy their first home are simply unable to. Looking at the data from ATO, just 1% of taxpayers own nearly a quarter of all investment properties across the nation. 1% own a quarter of the rental properties, right? ATO figures, which cover up until the end of June 2021, revealed that there are almost 20,000 individual property investors who own 6 or more investment properties. It's worth noting that this figure does not include investment properties held through various trusts, etc., and corporate structures. So my thing is that there's less than 20,000 people that own 6 or more properties in this country. That's a very small number, right? And it's very easy to be able to get into that level. But there's no way, look at this guy, look different, looks like they've cloned it. Pretty funny. Anyway, you wouldn't be able to get your way to 6 properties by negative gearing, because no successful business loses money. So you have to have the right strategy to get there. And it's interesting speaking with Nick just then on the phone. He said he's got 8 properties, and we've got 8 properties. I've never spoken to Nick beforehand, right? But it's having strategy, processes, procedures, and next they want to get to 20, right? Who wants to retire, 20 would be a nice figure to be at. 10, 15 would be good. 8 still good, but people out there are building wealth. You don't get that from negative gearing. I always said negative gearing sucks. It was never good at the start. It was never good today, and I don't think it'll be good in the future either. So I see that I've got another phone coming to me.
This is Christine.
Christine. Hey, Christina, how are you?
Very well, thanks, Nathan. Yourself?
Good, thank you. Good, thank you. Thanks for calling
Excellent.
in.
Thank you for having me. I do have a question for you.
Sure.
I'm a Melburnian and I've invested in both commercial and residential properties.
Okay.
I'm ready to grow my portfolio, but I'm not sure if I need to invest in a commercial or residential. I like the idea that with your tenants pay the majority of the outgoings of the commercial lease.
Yep.
But with the high interest rates and how confident are business owners to start up new companies, I'm a bit hesitant. Then on the other hand, you've got the demand for the residential properties and the tenancies. So is that the better option for me?
Good question. Good question. I think if we're going out today to buy a car, right? I had one of my staff. We got rid of a car the other day. We're replacing it with a new car. Caught up for a car, buying a car. So if you're in the market to buy one, do you need a ute, a sedan, a truck? If you were to go to sell the thing, if you've got a 10-ton truck, not everyone's in the market for a 10-ton truck, but everyone needs a car. And if I look at commercial property, I always think about what the bank requires from me to give me more money. And when I think of commercial, like I started off with residential. I've got a mixture of residential, commercial, and different assets throughout the portfolio. The banks ask you for a 25, 30, 40% deposit on a commercial property, but
Correct.
yeah, most banks want more deposit. And if you have a house, you could get 80%, 90%, 95% lending on that.
Yep.
So the reason why the banks are doing that is because they see commercial as being a high risk asset, is one thing. So they require more. So if you had $1 million to spend today, let's say, if we go back, let's say you've got $200,000 of deposit or equity to put into a property. With that 200 grand, if you were to buy a commercial property, but you had to put down a 40% deposit, you can only buy 500,000 worth of asset.
Which is quite small.
Correct. And if you were to put that into residential at 20%, well, then you could buy $1 million worth of asset. When it comes to commercial, I do like the aspect that the tenant will pay the outgoings. But how many times have you been driving down a road, just a major arterial road, you get stuck in traffic or whatever, you look out your window and you think, shit, that shop's been vacant for 10 years, it's got cobwebs in it, whatever. If a commercial property becomes vacant, it does pose a higher risk attached to it.
Yeah.
People always need a bread and butter for a roof over their head. That's why I like residential. I think it's important to have a balance, but unless you've got like 20 or 30 residential properties, I don't think commercial's the best thing to go to.
Okay.
With residential, there's an emotional aspect to it. So with a commercial, it's very logical decision. And what I mean by that is that when a commercial property sells, it's only based on yield. So if you've locked your lease in for a 3x3x3 lease or a 5x5x5, the property is only going to be worth a certain percentage of that yield. And as interest rates go up, they don't appear, like as you said beforehand, they don't appear as attractive. And like with a residential property, interest rates could come down, demand in the area goes up. There's lots of reasons that those properties go up and they double and triple and do their thing. But if you've got a 100 grand income or 50 grand income coming in as rent, let's say 50K a year, and let's say it sells at a 5% interest rate, 5% return, your property's valued at $1 million. But if that rent is the same for the next 5 years, well, then what's going to happen with the return? People aren't going to pay 7% interest rate and buy it off you for $2 million where it's giving them a 2% yield.
That makes a lot of sense, doesn't it?
Yeah. The other thing is that for my strategy of what I find is my foundation portfolio that I've built is that when you're buying an asset like a commercial property, whether it's a shop, an office, whatever, going back and ripping that equity out, it's much harder to pull the equity out of an office or an industrial building because there's less comparables in that location, and the valuers are basing it on that capital value based on a yield, etc. They take all those things into consideration. So I like residential properties because they are more liquid. Um, some of my favourite properties are commercial properties, but they are very illiquid. So the liquidity and the ability to move in and out of them, pull equity, all that sort of stuff, sell them, is much more difficult. So I do shy away from them in the initial phases of a portfolio.
Right. Yeah.
Yeah. And the other thing I didn't talk about in the current market, like you touched on yourself, like the economic climate, how many businesses are dropping and going broke every time I go on the news there. One guy.
Yeah, correct. That was my dilemma.
Yeah.
That's exactly right. So it sounds like it's a residential property for me.
I leave that for everyone to decide. There's lots more like intricate questions that I'd ask. You know, how many properties? You might say I've got 20 residentials already, or you might say I've got 2, right? And I don't need to go into specifics if you don't want to, but like if you've got 2 properties and you're buying commercial, it's like, well, that's, you know, that's a bigger risk there. If you've got 20, well then, you know, it's only a small part of your portfolio that's at risk. So,
Yeah, well, myself and my family have always been in the residential. It's just that we happened to buy a commercial property because we needed it for ourselves. We're actually a manufacturing company
okay.
and we're doing quite well. So we've now left that commercial property and heading into another one, larger premises. So,
Okay.
yeah, the question was, do I lease that and then perhaps invest in a second one or continue with the residentials that we've always been known to do? And
Yeah.
it sounds like it's definitely a safer option for me. And you are right. I've had a lot of more difficulties in borrowing against the commercial opposing to my residential properties.
Yeah. Yeah. I often think about one of my favourite properties I'll go into just for fun of it. I bought this property, it was 465 grand just for a shop. And it was vacant for 11 years. It was a Video Easy store. And they couldn't rent it, they couldn't get anyone in there. And I just thought, shit, this thing's worth like $1 million or something. It was just so cheap. So I bought it and I didn't rent it for 2 years. So I held it for 2 years without a tenant. And I rented it to AEC, or the Australian Electrical Commission, for the election
yes.
ones. It was like 2 grand for 2 weeks or something. Big whoop. But I secured a tenant. And I rented it to a major. I was about to say the name, it nearly came out of my mouth. I don't like, just for privacy of the company. It's a big ASX listed 200 company. It's never going anywhere. It's used as an infrastructure hub for them because it's got a concrete roof on it. I rented it for 100 grand a year, going up every year for the next 20 years. And it's like, they just pay me a year in advance every year, which is great. But it's like, if I was the previous owner of it, I would have sat with it for 11 years. It was like a big gamble. But I was like, about like 20, 30, 40 properties, whatever I had at the time. And it just felt okay, I could take that risk on. So,
Yep.
yeah. It's not that
I
they're
understand that.
bad or people shouldn't be buying them, but I've actually got a shop just about, I don't know, 500 metres up the street. There's like a strip of them. There's like 6 shops in there. And one has been vacant for 8 years that have owned it. Just, you know, it's how it is. It's like in an arcade part. So, yeah, it comes down to, you know, the risk. You need to weigh up the risk on that. So.
Yeah, I definitely wouldn't want to hold on to it for 8 years without it bringing in income. It's
Yeah.
a definite no.
Yeah. Cool.
Well, thank you very, very much for clearing that up. You've made some really valid points. Thank you.
My pleasure, Christina.
Appreciate it. We'll speak soon.
Speak soon. Have a good evening. Bye for now.
Thank
Thanks
you.
for calling.
Take care. Bye-bye.
Okay. Thank you. Cool. Keep calling if you guys are tuning on now. You're wanting to know how to hop on the phone to me. Leave a message in the DMs. Send a little message over with your phone number. A little bit of message about what you want to talk about. My team will call you from a private number whilst we're on the live and bring the phone in to me, and I'll answer your questions. No questions are off limits, obviously. Keep them PG rated, everyone. But with it, happy to help out where we can. Interest rates are nearly 8% here in New Zealand. Pass and go and do not collect the 200. Exactly. Lisa says here, one of our properties that Nave found for us was purchased for 260 nearly 3 years ago. Real estate agents ring me weekly to tell me to sell, offering 550, and the rent has gone up from 300 to 610 a week. Win-win. Thank you, Lisa. That's I love seeing that and hearing it. I don't often think about it. I know that when I think about your portfolio, it's like, fuck, I know there's some great ones in there, but when you spell it out and write it like that to me, it really does hit home because all it takes is 260 grand. If you had have bought, and you've done great with what you've bought and where your portfolio is going, but let's just say you took that one deal and did that 10 times over. That's 2.6 million worth of property that'd be now worth $5.5 million, right? That's gone up $3 million in the last 3 years, right? Who made $3 million in the last year? I don't know. Lots of people watching this and are part of the community do. But yeah, like if you just had that property in itself, renting 260, renting for 300, it's fairly neutral back in the day. But now renting for 600 at 260, we owe, I don't know, just make up some numbers, 200 grand, less than 80% loan on it. That would mean that, it'll be positive maybe $300 a week. If you've got a property that's $300 a week positive cash flow, you've got 10 of them, that's $3,000 a week, 150 grand a year. That's all it takes. You've got the debt attached to it, the assets have gone up. So that's sort of all it takes. So I think a couple of people are saying, where do you buy 200 grand property and what sort of property should I buy? They're out there. They're all around the country. Houses, townhouses, units, villas, duplex pairs. I've got a duplex pair at the moment, $140,000. One that I secured today. 2 duplexes, 140k. It's not for everyone, not for the faint-hearted, but it's a deal. I love tropical Queensland. Exactly, beautiful part of the world. The only problem is that you'll either get bitten by a box jellyfish in the summer, or you'll get dragged away by a crocodile. So the water isn't the best to be swimming in. But yeah, so hopefully nothing too bad there with the storm. Paul says here, commercial heaps for lease and for sale at the moment. I've been spending a lot of time in real commercial over the last couple of years, buying new offices for businesses that I run, buying motels and different things like that. And one thing I've seen the most is I've not seen bank repossessions on private personal properties like houses, townhouses, units, and villas. But the one part of the market which has seen, banks calling it debt has been a lack of liquidity. It's been the commercial market, lots of under administration, under liquidation, mortgaging, repossession popping up in the commercial space. Not saying that's a good thing to be buying, not saying it's a bad thing to be buying, just saying it's something to be watching out for because there is a lot of risk around that. So David said here, 2 properties with the granny flat on each, 1 duplex, valuation across all is 2.1 mil, weekly rent at 2,600, debt is 1.45, cost is 30 grand, slightly negative before tax, neutral after paying income. Broker saying no more borrowing capacity. Would you say that's true? Just looking at the glance, ideally I want to have 150 passive income. I could get debt clear by working next 10 years and pour all my money into it, however wanting to cut back on working hours. My question, David, is there's a lot of missing parts there. That's probably a question, if I could get you to drop a private message into the DM of this video, in the Be Invested video, on Be Invested page, sorry. If you could drop a little message in there and leave your number, and I'll get someone from my finance team to speak to you tomorrow because there's lots of missing parts there. I can see where there's a bit of an issue. I need to have a bigger part of the picture to be able to give you a rough non-mortgage broker answer to that, but I can see a 1.4 debt with 120 grand. It's got about a 8% yield. I don't see a big issue there, but there's lots of missing pieces. So I can get someone to give you a proper answer on that from the finance team tomorrow. So it's good to have a second opinion. So reach out. I have another call coming through, so keep those calls coming through. James? Okay. Hello, James.
Okay, Nathan, yeah. Thanks for the opportunity.
That's all right.
Yeah,
My pleasure.
Got a question. Yeah, thank you. Look, I'm in Melbourne, and I know you're a big fan of Queensland. And I'll get to that in a minute. I've got 250k in super, and I'm keen to access the property. And I've got about 520 or so for my home. I was just keen to find out what are the next steps. So I know I've got to talk to an accountant. I've got to probably talk to a broker. I was just sort of keen to talk to you as well. I guess I don't know where to start, especially with the super and trying to access the 250 in super.
I'm in a very awkward position when people talk to me about super funds because super is something that's very heavily regulated. You need to get the right advice around that. And whilst I can't give specific financial advice, I can't give any financial advice because I'm not a financial advisor, I can talk in general sense about the super, but you would need to get some advice around that. If you need help with being put in contact with a planner or someone to give you the advice on a super fund, just speak to the team afterwards or send us a message about that. But in short, when you're setting up a self-managed super fund, it's a general rule of thumb. This is just very general based sort of answer to it. If you have, most financial planners and most advisors would say it's most economical to be able to set up a super fund once you've got 200,000. So that's a good sign that you've got over 200,000 in your super. Have you looked at what your super fund has had in it prior to now? Like, if you've got 250k in there, has it gone up in the last year? Has it gone backwards? Is it the same?
It's been the same. So it's probably been like that in the last 18 months. So I guess I'm keen to sort of make it capitalise on it because it's kind of doing nothing.
Yeah. Well, looking at it, if someone was to have, like, in a super fund, you can lend in a super fund, which is good. So instead of having 250k in a super, someone could possibly be able to buy a couple of properties for like 250, 300 grand in there. So maybe buy like 500, 600, 700 grand worth of property. You've got to get the advice around that. So I've got to put a big disclaimer around that front, but definitely possible. The thing I like about property is that you can go and see where your property's at. You're telling me that you've got 250k thereabouts in your super, but you haven't seen it go up in value. Do you know what it's invested into? Like, does the super fund tell you?
It's all sort of balanced. So, obviously it's kind of aggressive, but it's actually in a fund at the moment. So it's attached to a bank.
Okay.
I
always think about the balance funds. Always want to know what's that into, right? Because they don't tell you what it's invested into, and there's a lot of things that have got massive risk into the financial system at the moment, and everyone should be really conscious. And I think the topic of super fund is it's important to know sort of where your super's at. Like, people aren't, specifically, how do I say it? A lot of people don't, when I ask people how much they've got in their super fund, they don't know how much is in their super fund. And that's a concerning thing because you've got $250,000 there. You don't know who's got their grubby mitts on that, where you could possibly have more control over that. And I think, definitely, worthwhile looking at that. So I've seen people with 250k buy 2-3 properties in their super fund. As a rule of thumb, like if someone was to buy, I know of many examples. I'm using this very loosely because it's very heavily regulated and I can't give financial advice around super. But I've seen people with 250k that have worked out getting 3 properties in their super, and there's lots of benefits from buying your super fund as well. As a part of an overall strategy, there's lots of tax benefits if someone was to have a self-managed super fund, and it's another alternative way to be able to buy a property. So if we're looking at, like, you may or may not be able to service under your personal name, the loans, when you go to take out a loan in a self-managed super fund, those loans are actually non-recourse loans, meaning that the bank can't take you personally for them. And when those non-recourse loans are there, there's lots of different servicing requirements around that. So it's important to speak to a good financial planner, your accountant, and a good mortgage broker. If you want help on them, we can put you in contact with them. But if you couldn't service under your personal name, you could possibly service under your super fund as well.
Yep. That's Appreciate it, Nathan. The other question I had is around Melbourne versus sort of some of the areas you're talking about, Queensland. I was keen to sort of get a feel for that because, Melbourne, I also see the market is not as progressive in terms of rents, in terms of capital growth. I was keen to hear your thoughts on it.
Look, I'll buy wherever the numbers stack up. And over the years, I haven't felt the same desire in Melbourne as what I have in other states. Buying interstate can be of a concern for a lot of people. So if you're based in Melbourne thinking about how do I buy in Queensland, you need to get things looked at from an investment side of things and not the emotional have. I'll tell you a story, James, that was from 2004. In 2004, the Sydney property market peaked, and I've just bought my first property in Sydney, and everything was starting to go backwards. I'd bought my things so far below market value. It was great. But I'd actually heard, this is before realestate.com, the internet and whatnot, about these properties in Queensland that were like $50,000 in Brisbane. And I went there and I thought to myself, yeah, this sounds good, but what happens if something breaks? I can't fix it myself. What happens, units don't go up in value. I had all these negative connotations about buying interstate. And then I saw these properties in Sydney that were going sideways for about 5 years. The properties in Queensland had gone up from $50,000 to $200,000. Those things now are worth maybe $350, $400, and are renting for $450, $400 a week now. So looking at property markets in general, not all of them go up at the same time. If we look at Sydney today, there's some areas in Sydney that have gone up a lot in the last few years, but there's still areas that are cheaper in Sydney than what they were 5 years ago. Or 7 years ago even. So you need to be looking larger afield. If you can't find the yields happening in Melbourne or the numbers stacking up for in Melbourne, you should be looking further afield. And I quite often think about buying interstate like shares. If people own shares in Woolworths or McDonald's or wherever, are they going and looking at every single store around the country to see if those properties look nice or the shops look nice, etc. You need to do your numbers, need to do your research, make sure you have someone on your team that can help you. I could shamelessly promote myself as being the best buyer's agent in the country. If you want help on that front, you can reach out to the team, just message the team afterwards and have a chat with my investor relations team to discuss what we can do. But yeah, in short, I look at the price of what's going on in Melbourne, and I'd rather buy in Sydney because you're getting better value in Sydney. I look at the yields that you get, and you can get better yields in Queensland. You can get better yields in Perth. If someone said to me today, which one's the best to invest in, I think there's opportunities all around the country. But if we look at Sydney and Melbourne, for example, you could literally just drive between Melbourne and Albury coming into New South Wales. Every 10 minutes, you could just build another housing estate. The market there is not landlocked, where if we look at Sydney's the doormat to the country, and it's sort of stuck in with the boundaries of the Blue Mountains and Newcastle and Central Coast, and you're sort of gridlocked on the land front. So I'd rather be buying in Sydney. It's my personal view.
Great, yeah. Thanks, Nathan. Appreciate it.
No worries, mate.
Thank you so much. Yeah.
We'll keep them coming. Thanks for that, James. Beautiful. I've got some more questions here. I don't know if there's more coming through. If you do have questions, put them into the DMs of this page, and the team will call you from a private number throughout this video. Joe has said, where in New South Wales would you find suburbs under 200,000 worth buying into? I actually bought something very interesting the other day for one of my clients. It's a 5-year-old shop, and I paid, it was listed for much more than this. It was a very interesting buy. I bought it for $110,000, right? It's a 5-year-old shop. But this thing has the opportunity to be turned and converted back into a residential unit. It's probably worth about $300,000. So that one there is need to do a little bit of work. I prefer not to do work on things. If we look at other locations, without giving out specific locations, right? I bought some houses recently in New South Wales for investors, large regional hubs, like some of the largest regional hubs in the country. And these properties have been houses for like 200, 220, rent for 370, 400 a week. So it's still out there. If we look in Sydney, I've bought properties in Sydney in the second half of 2023 for well under 300,000, 250, 270,000 in Sydney metro sort of area they're for units. But if we look at houses in the Sydney market, I'm not a big fan of value what you get in Sydney at the moment on house front. So yeah, but other areas in New South Wales definitely. I've bought some blocks of units this year for 500,000 in New South Wales. I've bought duplex pairs. I've actually got a duplex pair at the moment that I just secured in New South Wales for 210,000, rents for about 450, 500 bucks a week. So yeah, reach out to us if you want help on securing those type of properties. Matty says here, do you think there will be a property crash in Australia in the next 10 years? Obviously, when we get the currency reset. I don't think we'll see a property crash. I think we will see instability in our monetary policy, and we'll see instability with our currency, and I think that we will see times when things go up and down and overvalued, undervalued, and the general direction of where I see everything heading to is inflationary. And if you look at the expansion of our monetary supply, I don't have the chart on me at the moment. I can't even. I'll see if I can draw one. Here we go. Do I have a pen here? I don't have a pen or a texter. No, nothing here to draw on. So we're out of luck on that front. The inflation compared to, like, if we look at monetary control, you can go look up M1 money in Australia, M2 money supply. I'm getting a pen, or I can see a pen getting run past the glass wall here with a pen. In short, if we look at the level of currency creation in this country, it used to be much lower. It was like a very flat line. Used to be a flat line, and then it's gone up and up and up and up and up, and now it's at this sort of point. The more currency that they print, the more that things get inflated away. It's not the property or anything going up on top, it's the money losing its value. So I'm very optimistic on that front, because the currency is just going to lose all its value. So keep the questions coming through, keep the calls coming through.
Kylie,
okay. Hello Kylie, how are you today?
I'm good. How are you?
Good, thank you. Thanks for calling in.
That's all good.
How can I help you? What questions do you have for us?
It was just in regards to land tax and yourself with such a large property portfolio. How does it affect you, and what are your thoughts on it?
Yeah, I just took a big sigh. Thanks for reminding me it's land tax season again. Look, a lot of people in my portfolio, I've got some properties that cost me 20 grand a year in land tax. Just each property cost me that. Some of them are 30 grand a year, which is a lot, and they're negative geared, maybe 30 grand a year as well. So they might be costing me 60k, but they're very large land holdings, which are subdivision sort of potential. But offset to that, I've got properties that are positive 100 grand a year or 50 grand a year, etc. as well. So I want to know, when I'm buying an asset, what is the reason for me buying that actual property, and what's it going to achieve for me? And I think a lot of people, like, I did a podcast on this recently, and it was about houses versus units. And a lot of people just say, that houses are good and units aren't good. And if we look at place, I'll just use the Gold Coast in this example. It's the easiest example to explain because it's happening in real life. Units that were buying for 200 grand a few years ago are now selling for 600 grand, but houses that were buying for 500,000 are selling for 900,000. So the units are actually going up a lot in these locations, not in perspective to the house. So in my portfolio, I do have a lot of units as well. And when you look at a unit, people think, well, you've got to pay strata fees and stuff like that. But it's like, well, they're bringing in a greater income than the purchase price. So that extra cash flow can go towards some of those strata fees. But when you look at a house versus a unit, you have like you're buying a house, you have to pay building insurance. You're buying a unit, you're paying strata levies. But when you're buying a house, you are increasing your land tax liability versus a unit. So I've been able to minimise a lot of my land tax liabilities over the portfolio by buying units rather than houses. I don't buy, a block of land in the most expensive suburb of the state either. So I am mindful of it, and I'm more mindful nowadays than what I ever was in my portfolio. But I'd say my land tax bill, if I had to guess, across all the states, maybe 150 grand a year, 200 grand a year, which is a lot. It's pretty bad. But when I break it down across all the properties, it's only a little bit here and a little bit there. But I've been able to minimise it by buying in different states. You can't avoid it. That's the problem. It's a massive scam. I'm very against it. There's a worse one, which is payroll tax, which hits businesses as well, which is from the same department. Very terrible taxes, and it is a rip. But I think it's a trap for people to be locked out of markets. But you can sort of glitch it by buying. That's why I talk about buying the cheaper properties with such high cash flow. A lot of my clients, they get like 20 properties. They don't even pay land tax because they might have 5. Let's say you've got a couple and you've got 2 spouses. They can. If we look at Sydney, for example, I think it's about 800 grand a year land tax threshold. So if you buy a house for $1 million, you might have a land component of 600, 700 grand. You'll hit that in one go. So after 2 properties, 3 properties in Sydney, then you'll be paying land tax of 1.6% of anything over that. But if you were to have two people and they'll buy 4 units which have a land component of 150 grand inside them, you could buy 2 people buying 4 properties. There's 8 properties, 9 properties in New South Wales or in Sydney Metro without paying land tax yet. And then you go and buy another 5 properties in Queensland each, and you buy 5 properties in Perth each. You could be at 30 properties in a household without paying any land tax. There's ways to minimise them in some states by putting them into trusts and whatnot, but then you're paying more trust fees. So I just pay it because I know I have to, but I'm mindful of the cash flow on the way into the portfolio as well. But it's something I've never tried to avoid. I'm like, okay, they got me.
Mm.
Yeah.
Yeah. Is it something that you think will get worse, or being that it's still reasonably new with what they've done?
Oh no, it's terrible. It's not going to get any better. The problem is, I think I did a bit of research in this many years ago, and I looked at when it came in. I think it came in at about 1900. Actually, like it was like 100 and something years ago. It's not new. And they wanted it as a deterrence because they called people landlords. We're landlords because we're the lord of the land because they were owning too much land. So it was something that came in from the Crown back in 1900, and it's just stuck. But the problem is that properties were worth, 5 grand or 2 grand for like 100 acres in Sydney going back 150 years ago. But now a 250 square block is worth $1 million. So as the prices have gone up, 1.5% of $1 million is 15 grand a year in land tax, and it's not getting easier for people. It's not getting better. So I do think it will cap and it will hurt a lot of people over the years, and it's a cost that needs to be passed on. But how much of that cost can you pass on? If you've got a large land holding. So I try to keep. I'm mindful of the decisions that I buy when I buy land in properties. And as I said before, like some of them are terribly negative, but those properties have gone up from like $1 million to $6 million. So it's like, it's not that bad, but it's not, it's just ugly. So
yeah. Okay.
But
thank you very much for clearing that up.
My pleasure. But do think about when you're building out the portfolio, you could buy some in this state, some in that state. Land tax is only defined by the state. Yeah.
Yeah. Is that something you look at when you're expanding someone's portfolio?
Yeah, it's not front of mind, but it's generally when I'm building out a portfolio, I would be spreading, the assets across different markets, across different states anyway, just for risk minimization. So, yeah, I don't see most of the portfolios that are built, I don't see people hitting like massive land tax there. They might pay $1,000 or $2,000 a year across, or $5,000 even across like 20 or 30 properties, which isn't much in the grand scheme of things. Yeah.
Yeah.
But it is.
All right.
My pleasure. Thanks for the call, and yeah, I hopefully answered your question.
You did. Thanks,
Awesome.
Nathan.
Thanks,
Have a good night.
Bye for now. Awesome. We'll keep the calls coming through. I think we've got more. Have we got more coming? Okay, cool. If you've got questions, DM them in to the team. Send over your number. My team will call you on a private number, and we'll get you on the call for our telethon tonight. I've got more questions coming through on our comment section here, so I'll answer some of them as well. And I've still got the ones that came from Instagram. I've got a full list. I'm not going to go into them and show everyone, because then it'll be not a surprise when I answer it. What have we got here? Jono says, hey mate, only you could get me on Facebook. Always interested in your thoughts. Thanks, Jono. I appreciate that, mate. Which one of you is best options at the moment to buy established dwellings or construct in terms of saving costs? Good question. Going back a few years ago, I was building properties because there was a good opportunity there, because I could buy land cheap, negotiate with builders on the cheap when the market was much softer. But at the moment, I have not built any properties for 5-6 years. I don't recommend on building them because A, you've got to make sure your builder survives and doesn't go and blow up in the middle of your construction. 2, the costs are blowing out massively. And 3, I just don't see the value out there. I see too much risk around it. And 4 is taking you out of the market whilst you could be doing other assets. So when you're building a property, there's no income coming from your property. It ties up a lot of capital, and it's just not that good. So, especially in this current market, there's much better value by buying established properties. So, yeah, that's just my thoughts and view on it. Sam says, do you think a 50-year mortgage will come here soon? That should give more investors the ability to retire, as it will increase cash flow without the need to refinance once they have left employment. I think it will all add, right? Like, we look at all these booms that we've had over the last few decades. I could try and draw them. Someone bought me in a texter recently, which is good. So I'm just going to draw. Don't mind my drawing here, right? I'm just going to draw a property chart, right? I'm just going to make the assumption that it's gone up like this, right? I'm going to put some critical dates here. I'll answer that question as well. I just made a little chart, right? This may not be the actual property charts that you would see out there. It's just for an example, right? So my thoughts are, if we would go on a 50-year mortgage, would it change things? Every time that there's a problem, right? We had an issue in the 1960s with our currency. In 1971, they changed our currency. When that happened, we had a big level of inflation. That went through until about the 1990s, where the recession that we had to have, where we had the market go down and then go back up. But in 1990, what they did is they changed the way that the economy worked, and they changed the markets, and they did some tricky cooking of the books, right? And every time they do, they cook the books. So in 1990, 1992, this could be very politically incorrect from what I'm about to say, but just bear with me, I mean nothing by it. But as a kid, I grew up in the 90s, right? And as a kid growing up in the 90s, if I went and asked 10 of my mates, what does your mum do for work? They'd be like, my mum stays at home and looks after the family, she cooks us food and all that sort of stuff, right? You had one income in the house, right? But in 1990s, what they did is that they had a recession and they made all these Ponzi schemes out of it. So what they did is they created childcare. And with childcare, they created childcare rebates and created the whole, early learning education and whatever. So, and then they encouraged the mother to go and get a job, right? Give everyone rights and all this sort of stuff, right? So in that period of time, what they did is that instead of having one income earner in the house, they had two income earners in the house. When they had the two income earners in the house, that created a new boom because you had more money and more disposable income, so things were able to go up. Then around the year 2000, certain things happened. We had the GST, we had the baby bonuses, we had first homeowner grants introduced. So we had a 7,000 homeowner grant introduced around 2001. Gregory said here, and break down the family unit back there, exactly, but we're not going there today. But reading between the lines, exactly what happens, right? In 2000, they created the first homeowner grant, right? So that created another boom off the back of another Ponzi. Then in 2008, they had the GFC, they dropped interest rates, they changed the way that you did. In the middle of this, also, there was years of booms. What happened for those booms to occur? Back in 1970, you'd have to put down like a 30-40% deposit. Then they made it easy to get loans. And you used to have to go to the bank and put a suit and tie on and ask the bank, what do I have to do to get a 50% mortgage? Nowadays, they come to your house, they pest you like whilst you're eating your dinner or whatever. Hey, refinance your mortgage, whatever. They'll give you cash backs for it. They're all trying to change the way that they get your business and get that market share of their business. So you can literally put down a 5% deposit, a 3% deposit today, and buy a property. Now the government will give you the deposit. There's no mortgage insurance payment. So all these things, there's building grants. So in 2021, we saw a boom based on the fact that they give everyone 50 grand to build a house. That's why we've got a building boom, and no one was able to handle that correctly. 2008, we saw rates drop. We saw different loan products happen. There was no doc loans, low doc loans, right? 2-day income loans, right? All different types of loan products, and it's just getting looser and looser and looser. People literally pay interest only forever. There'll be a day where they just pay interest. That's it, right? So that's my thoughts on, what will a 50-year mortgage happen? So now, it says here, Gregory said, now they want to own 40% with no generational wealth can be built. Commie system, right? And when you look at it, the government want to go you halves in your mortgage. It's very bizarre, but it's creating new bubbles out there, which is pretty cool because those that were in early benefit the most from it. Take advantage of it. Got another call?
This is Casey.
Yes.
Beautiful. Casey, Nathan here. How are you?
Good, thank you, Nathan. How are you?
Good, thank you. Thanks for calling in.
That's okay.
How can I help you?
I want to know how to get into this crazy rental market and investment market at the moment.
Okay. When you say how to get into it, like in what way? Sorry.
So when I do the calculations, I find it almost impossible to become an investor.
Okay.
With the repayments as it is, we're a young family, my partner and I, and we have a lot of kids, and I just don't see it viable, even though it's something that we really, really want to do, especially to leave something for our kids.
Okay. Have you got a deposit? Have you got equity in a property that you own already to get started?
No. So we have a deposit.
Okay.
We are after something that's probably on a larger scale because we have 6 kids.
Okay, so this is for you to live in, is it? Or is it for an investment?
Well, originally it was to live in, but when I juggle numbers, it's something, the mortgage repayments is something that we could not afford. So then I'm going down the track of, do we have it as an investment?
Yeah.
And still rent? Because when I spoke to somebody, they said, if the average home in Sydney is $1.2 million, which means the mortgage repayments can be up to $2,000 a week.
Yeah.
If you rent somewhere for $700 a week and don't have to pay any maintenance for your rental that you're in, because the landlord pays all that, and you were to save $1,300 a week as if it was your mortgage repayment, if you did that over 30 years, you'd be better off than actually buying an investment property.
Yeah. Good point. What sort of price are we looking at paying for a property to live in?
We could afford something very small and be uncomfortable
Yep.
as a family, or we'd love to own something that is comfortable for our family, which means acreage and say a 7-bedroom home, which we're looking at up to $3.5 to $4 million.
Okay.
But there is something that we could possibly secure in and around the western suburbs for say $1 million or 1.5, but it wouldn't be our forever home. And it would most probably just to get our foot in the door, because we wouldn't be comfortable there. We've just got too much of a large family.
And what sort of rent are you paying at the moment?
We're paying $1,000 a week rent.
$1,000 a week, yeah. Okay.
Yeah.
So $1,000 a week, 52 weeks, 52 grand a year. You get a mortgage of $1 million at say 6%. You'd be paying more interest only at 6% on $1 million. So I see your dilemma that you're stuck in. I don't think it's going to get any easier, which is an issue, and it's not probably the answer you want either. I don't think it's going to get any easier, but like what you're saying is like really, really, it is a big thing, and I think it's a question for a lot of people to have. I'm going to give you an answer with a couple of situations on it. It's pretty detailed, maybe, but. You're familiar with rent vesting? Someone just wrote rent vest on the page here.
No, I'm not.
Okay. All right. I just assume everyone knows about it, so this is cool. I'm excited to share it with you. It's a very common thing, but it's something that I'd look at, and it's something definitely that I did when starting out as an investor. So I grew up in. Everyone in the media always says I grew up in Mount Druitt, which I didn't. I bought properties in Mount Druitt, but I grew up in the sort of Hills district. And at the time when I was 18, I was like, I want to buy property, but I couldn't afford it. So I went out and bought my first property 20 years ago in Mount Druitt. And I was buying all these little cheapies. And what I realised is that I could buy, say, 5 houses in Mount Druitt, which would be like, say, let's just say 200 grand a piece, so $1 million worth of property. But for that same 5 properties in Mount Druitt, I could buy 1 house in Borkham Hills for 400,000. Yeah.
Yeah.
Or 500,000 in Borkham Hills. But I would have had 5 houses, and I'm using the word houses here because that's what I used to buy in the day. I call them properties now because it's a unit, townhouse, whatever. But the reality is that I have now 5 hooks in the ocean to catch equity, growth, and cash flow instead of a red brick house in Borkham Hills for $500,000. If the market doubled tomorrow, I would have that $1 million turn into $2 million in Mount Druitt, or the 500,000 in Borkham Hills turn into $1 million. So, and those things have gone up in proportion with each other. So having the largest asset base is very important. I bought my first house to live in. It was $1.2 million, and interest rates were like 9%. It was crazy. And I bought it, and things were good for me at the time. But what I had a fear, like after I bought it, I was like, shit, what happens if I can't afford it one day, whatever. So I went and put up about 30 of my rents by about $20, $30 per week each. So I ended up getting about $700, $800, $900 a week rent. And I was like, shit, my tenants were able to pay for me to live in my house to live in. And it was at that point, I was like, that's what my portfolio has done for me. So looking at it, like, if you were to buy the house, let's say, I'm just going to run some numbers here, $3.5 million, and if you were to put down a 20% deposit, that means you need $700K, and then you need a $2.8 million loan. $2.8 million loan at 6%, that's about 200 grand a year in interest. That's 4 grand a week. It's massive.
Yeah.
Massive money. So it's a big thing, right? So if you were to rent that house, how much would it cost to rent that house? It might cost you, what, 1,500, 2 grand maybe? How much?
Yeah. Yep.
So you're going to be like 2 grand a week, 2.5 grand a week better off. For me, I'd rather take that money and go and buy assets. If you were to go buy, say, 10 properties at 200 grand a piece, there's a big difference here. If you've got 10 properties at 200 grand, those 10 properties are still $2 million, but you've got 10 tenants in there and they're going out every day earning money, paying you rent. But the difference is the house that you'd buy to live in would be severely negative geared if you were to buy it. Like, it would be negative cash flow, even if you had a tenant in there. So rent where you want to rent and buy where you can afford, and then you get the growth. So if you bought 10 properties and they all went up from 200 grand to 300 grand, that's 2 million turning into 3 million. You'd have $1 million in equity there and a cash flow stream to be able to support itself. You don't have to pay anything for that. It's probably putting money in your pocket. I actually did a podcast specifically on this, like really in depth, with one of my team members who wants to buy a $3.5 million. You wouldn't believe it. It's a $3.5 million house he wanted to buy. It was pretty funny. I filmed this the other day. His name's Stephen, and he said he wants to get 35 properties. And actually, no, sorry, go back a step. It was $3.5 grand a week his mortgage would cost him if he was to buy the house. And his goal is to get 35 properties, push the rent up $100 per week, positive cash flow, and then make his tenants pay for him to live in his house that he wants. So if it was me, that's literally what I've been able to do. Over the last 20 years, I could have done it much sooner, but I bought my first principal place 10 years ago. 2 years ago, or 18 months ago, I bought a house. It's my dream house of the day, and it's $4 million. And I thought about it. And when I bought that house for $4 million, I didn't think much of it. I was like, okay, what do I need to do to make it happen? I put on a 6-month settlement. I actually sold off, like my portfolio, like, I don't know what you know about my portfolio. I put a lot of stuff out of there over the years. People listening might be like, I don't know, Nathan has properties or whatever. But I've got like 250 properties in my portfolio, just little ones, like 200 grand, 100 grand, 300 grand sort of things. I sold a property that I bought in Noosa. I bought it for 330 grand. I paid it down over 10 years. I owed 200 grand on it. I sold it for 1.2. I had $1 million profit in it. I never stepped foot in that property. It made no difference to my lifestyle. I bought it in a complex of about 50 units. People say 50 units wouldn't go up in value. I bought maybe 15, 20 of them for myself and my clients as well. So we all bought in there. And that property gave me $1 million. That's 1 million of 4. So I had to find another 3. And I went and sold about 5-6 properties in the Gold Coast that I bought for 150 to 200, sold them for 500, 600, pulled in another 1.5, 2 mil from that. And I settled the property with like a very small mortgage, and I'll pay it off over the next 2 years. It's 1 year since that. It's a 3-year loan, and I'll pay that thing off, find a way to make it happen. But if I didn't make the decision 10 years ago, I wouldn't have had the options to do it today. And I was talking to one of my clients whilst I was driving, actually, one day. I was just having a chat on the phone, and it occurred to me, I was like, $4 million house, if I had to pay, sorry, just hearing noise in the background, someone else is on the phone as well. If I had to get that $4 million at $50,000 a year savings, that would take me 80 years to save up to buy that property. No second job's going to be able to do it. So it's like, it's got to try and find a hack to make it happen. Rent vesting would be the way that I'd be trying to make that happen. Rent vesting would be the first way, but I'd be definitely getting into the market, but I'd be getting positive cash flow assets that are putting money in your pocket each week. So if you've got 10 properties at 200 grand, it's minimal risk. You've got 10 sets of tenants. It's below rebuild cost. If you ever had to sell them, you could dispose of them pretty easily. If they're putting $100 a week in your pocket, well, then suddenly you've got 10 times 100, there's $1,000 a week that'd help pay your mortgage. When you do get the mortgage, those properties go up by 50 grand or 100 grand each. You've got $500,000 or $1 million there in equity that you could tap into and then use as a deposit to buy your $3 million property.
I'll have to go deeper diving into your podcast that is all about this.
I don't know when it'll come out, but the person that you messaged on here, I will get them to write you a message of when the episode will drop. They come out on Thursdays. It's not a little promotion here of where to get my podcast at, but it's called the No BS with Birchie podcast, and it comes out every Thursday on Apple Play, Google Play, Spotify, and YouTube. So yeah.
Okay, great.
I'll get a link in there for you because it's a really cool. I actually did two with Stephen, and they were very similar, sort of overlapping. But the one was very much about rent vesting, and I think you'd probably find a lot of good resource out of that.
Definitely, because I feel like this is the only way to go in this day and age.
Yeah, I wouldn't have been able to get into my house that I live in today from working 3 jobs. So,
Yeah. And realistically, that's what it is, because I'm a business owner myself,
Yeah.
and even though we probably earn a lot more money than what your average family does, we still can't afford it. So I don't.
Yeah.
You're stuck between a rock and a hard place, because there's just no way out, and they say that the Australian dream is to own a house, and that's what you leave your kids, and everyone's happy, but it's just not suitable for this day and age.
Yeah, you need to be smarter than the average bear, and that's the thing. And the reality is, I always think about it, right? Like I like in my area, they're all big lands and they're all worth, sort of big like that. And I'll walk sometimes at my beach house, and like I look at these big waterfront houses, and I'm like, shit. And people have money, like people have bought them, but it's like, how did they get there? Like, what was the struggle 20 years ago? There's always struggles for people in all different generations, but it's like, how do we sort of hack that and overcome that? So, yeah.
Yeah, very true.
Yeah. But don't give up. Like, I could talk to you all day about this, but rent vesting, that's the answer. I'd be buying, like if it was me in that position, without giving financial advice to anyone here that's listening, if it was me, and it's exactly what I've done, I'd go buy myself 20, 30 properties. And when I say that, like it sounds like a lot, right? Like you're talking about buying a $3.5 million house to live in. If you buy 20 properties at 180, 200 grand a piece, that's the same amount that you're spending. But the difference is that you're on the hook to pay a mortgage of $4 grand a week by buying that yourself. But if you've got 20 tenants paying you $300 a week, you're getting $6 grand a week in. That's an extra 300 grand a year income with that same debt.
Yes. Yeah.
Big difference.
Yeah, it makes a lot of sense.
Yeah. Awesome. Hopefully I've given you a bit of hope and pointed in the right direction today.
You have back to the drawing board. Definitely back to the drawing board. So.
Awesome. Well,
you have been. Thank you very much.
I'd love to hear what you get up to in the next couple of years about how you get into that house, but don't give up. Like people are buying these things, people are doing these things. Yeah.
I'm sure I'll reach out again before then for some extra advice, but it's definitely set the way so far.
I just saw a text come up on my phone. I've got a mate that I'm going to go to the gym with tonight, and he is one of my investors, and he just recently bought himself an acreage similar to what I'm talking about after building the foundation portfolio. So very, very possible. So.
Yeah. It's just mind over matter, and when you work towards it and believe it, you make it happen, I suppose.
That's it. So outsourcing those costs. Try and outsource them as much as you can.
Yeah.
Awesome.
All right. Thank you so much for that.
Have a good evening. My pleasure. Speak to you soon.
You too. Thank you. Bye-bye.
We've got another call coming through. This is pretty fun. I actually really like this. This is fun.
We have Lisa on the line.
Lisa, how are you?
I'm good, thank you, Nathan. How are you?
Good. Sorry for the delay in getting to the
Oh, that's okay. No problem.
How can I help you?
Yeah, I was just wondering, I'm in my early 60s and we own our own home, and just I'm asking for like opinion as far as going into buying investment property at our age group.
Okay. I always get really conservative when I hear 60 years old and stuff like that, and I think it's really important that if we're talking 30 years, like there's lots of times for mistakes and fix up mistakes and stuff like that. So I'm very conservative with my suggestions and my feedback on when you're at 60. But very, very possible. I've got a couple of clients that have been well into their 60s that I've been able to build like 10 plus property portfolios for. But looking at it, like, look, I guess the good thing, like, if you're calling me up and you're 20, you're probably like, oh, I'm trying to trying to scrap my first deposit together, and like you're at a different stage in your life. So my thoughts would be different to being 62. You've got access to super. You can bit of static on the phone apparently for everyone. So yeah. So can everyone hear me well now? And or is it still making? Sorry about this. I'm just reading the Facebook message through. Is there static? Okay. Everyone's saying that it's fine now. So yeah, looking at your position now as to what assets and whatnot you've got. Do you own your own house that you live in at the moment?
Yes.
Yeah, cool. So you've got equity, you've got capital. Are you working still, or?
Yes.
Yeah, cool. The banks will look at you at a certain point because they've got to put in there a risk and a payoff of the debt in their strategy when writing you a loan. So there is, once you hit 60, up to about 65, you'd be fine. But once you get past 65, they want to know how they're going to get their money back in the next 20, 30 years. And if you're not working, that makes it more difficult. But 62 is fine. You've got a lot of equity in your house, I'd imagine. You're working, you're probably at a good income point in your life. Lots of good things going for you to be able to build out the portfolio. I guess, given the age of where you're at life, you'd want to be focusing more on a cash flow perspective rather than a capital growth. Like, you don't want to be getting stuff that's going to be costing you in that. But I'd try and minimise the risk by, if you could, I can't give financial advice. I'm being very conscious of what I'm saying here as well on the camera. But if it was me and I was looking at getting started and I was 62 years old, I'd be like, okay, what are the options? What do I need to get me through life? I'd start with working out an income goal. So, do you have a retirement figure that you're trying to hit from your cash flow?
Well, yes, but I also have a business, so the cash flow side of things would be from that.
Oh, I mean, like, say if you retired today, how much do you want to earn per week?
Oh, okay. Oh God, I'm probably, I don't know, 500 a week.
That's very modest. That's 26 grand a year.
Yeah, 26 to 30,000 a year.
30 grand a year. Okay. Very modest. Like, let's just go with 1,000 a week, 50 grand a year. That's very achievable.
Okay.
So you want $1,000 a week. You're going to need maybe 3 properties owned outright, bringing in $300, $400 a week. So how do you get 3 properties? You would buy 3 at 200 grand a piece. So you can work real hard and pay them off. But if you're working real hard paying them off, like, you're paying a lot of tax, inflation is doing you a disservice, etc. You could possibly buy 6 at 200 grand a piece. They double, go to 400 grand. You could sell off 3 and pay it the other 3. That's another option. Another option could be that you just buy 10 and push the rents up $100 per week and get yourself $1,000 a week, buy 10 properties at $100 a week positive cash flow. So, yeah, looking at options, there's lots of options there. Probably the first place to start would be speaking to a broker, seeing what options there are from a lending perspective, and then trying to fit the property strategy around that. But there's definitely lots of properties out there you can pick up for 200 grand, 300 grand, a positive cash flow, $100 a week. So
yeah. Okay, that sounds like a great idea.
I'm not a big fan of buying a block of land, subdividing it, adding a granny flat, adding a second dwelling, because there's risk associated with that, and it's a lot of hard work. Like, I don't like renovating properties and stuff like that. Over the years, I've had to because they get older at some point. But I'm not in that sort of flipping. Like, you're 62. How many people have you ever spoken to in your life where they're like, I wish I bought more, I wish I didn't sell a property, etc. Like, buying a property and selling it isn't, you can make a few dollars from it, but it's a very active role. You're just buying yourself a job by having to buy the property, renovate it, sell it, and then your money has lost its purchasing power as well with inflation. So I'm just a big fan of having a buy and hold strategy. So, yeah.
Excellent. Well, that's a lot of food for thought. Thank you, Nathan.
My pleasure, Lisa. Thank you for the call in today, and thanks for watching. And
No
hopefully,
problems.
I've given you some motivation.
Certainly have.
Someone just said, here's a bit of motivation, and said, step it up, girl, 100 grand a year, right? So it's very scalable, very scalable. If you wanted 100 grand a year, you just need to double those numbers that we just spoke. So 6 properties owned outright, 12 properties to buy, and if you had 12 properties giving you 100, 150 bucks a week, that's just a passive income stream there of 1,800 bucks a week. So.
Yes, exactly. That's great.
Awesome.
Wonderful. Thank
Oh,
you so
listen.
much, Nathan.
My pleasure. You have a good evening. Thanks for calling.
You too. Thank
Okay.
you.
Bye for now.
Bye.
Last call for the day.
It's Ty.
Ty. Awesome. Thanks, Ty, for calling in. How are you?
Good, mate, yourself?
Awesome. Awesome. I'm having fun by this. So thanks for calling in.
Oh, that's okay. No, I was just got a couple of questions. So I've got a rental property that was meant to be our forever home, and that sort of changed. At the moment, I'm renting it out, and the rent doesn't quite cover the mortgage, but it's got about 250k, I guess, in equity.
Okay.
But also, I have about 500k in the bank, and I'm sort of tossing up between what I sort of do if I want to reinvest or if I want to pay the house off or bring the payments down so that way the rent covers the mortgage and all that sort of stuff.
Yeah,
sort of struggling to figure out what the best way to do it is, I guess, to keep the cash flow for an investment or,
Yeah. Okay, cool. I've got lots of questions for you.
Sure.
Ty. But the way I'd look at it, like, so how much do you owe on the house, the forever home that you've rented out?
So there's 370,000 left owing on it now. We bought it for 500, but it's sort of calculated roughly to around 700. It's sort of worth now. So there's probably, like, confidence-wise, I'd say 200, but there's sort of room for more equity, I guess, in it.
Yeah. Okay, cool. And what's it rent for roughly?
450 a week.
450. Okay.
So it's a sort of a rural sort of property, but I could probably up the rent a little bit, but probably not too much more.
Okay. Well, up in the rent's one good start. It helps you cover the cost, but I can see instantly the issue there. Like, you paid 500, you're getting 450 per week. It's like less than a 5% yield, and the interest rate's like 7%, 6%. Yeah. So I'm not a fan of selling property, so I'm not going to tell you that. How to fix that up? Some people would say add a granny flat. Some people will tell you to pay down the debt, whatever. The problem that I see is, like, you put your 500 grand against that. That's an opportunity cost there. Your money is losing purchasing power because inflation is strong. You pay out that loan, and then it goes back to money heaven, which is basically you're paying out the debt, it just retires and is doing its thing. If you pay out a mortgage, you're basically looking at the point of saying, I can't get a better return than what the interest rate is. So if you could, with that, I'm just going to break it and chop it into a few different parts. And none of this is advice for anyone watching or for you. It's just having a chat. So if you just looked at it simply, if you paid 370 grand off this property, you'd only have 130 in the bank. What I would do, if it was me, and this is just like a real, like,
hypothetical,
hypothetical, I wouldn't do this, but I'm just drawing a aha moment for us here. If I would go and buy a property for 370 grand that gives a 10% yield, right?
Okay.
Because then now you've got 2 assets. You don't have just that one house. Like, let's say your house is worth 700. I'll use a totally different number, right? Let's say I've got $1 million house with $1 million mortgage. I'm just hypothetical, and someone gave me $1 million in the bank, right?
Yep.
I could easily pay that $1 million mortgage out and have 0 debt and have the $1 million asset. If the market doubled tomorrow, that $1 million would turn to $2 million. If I had to sell it to buy something else, then everything else around me would have been inflated away as well.
Yeah, definitely.
Instead of paying off the $1 million worth of debt at 7% interest, which would be 70K per year worth of interest repayment, I would rather take that $1 million and buy $1 million worth of property that gives me 100 grand a year.
Yeah.
I would then take the 100 grand and chuck that towards the $1 million mortgage, paying down a bit of the principal as well as paying down the interest, right? Because how my financial position would look then is that I would have $2 million worth of property with a cash flow of 100 grand coming through with a $1 million worth of debt at a 7% interest rate.
Right.
If the market doubled then, I'd have 2 million turning into 4 million. Gives you a lot more options.
Yeah, definitely. Sort of, it's a bit of a, I guess, an average box was meant to be forever home, but in terms of wanting to invest and stuff, it's sort of, I guess, starting on the back foot if I didn't sort of have, a fair amount of savings. So,
but if it was me, right? If it was me, I said that would just be like a scenario, which just to draw it out. If it was me, like I've had clients that have had $500,000 that have bought 20 properties in 2 years. I've got one person that bought 38 properties in the last 3 years, started with like $500,000, and had a lot more debt than 370 to start off with. So, looking at your position, I'd be trying to get it bigger, right? Like, let's say if someone had 500 grand, you could buy potentially. I'm just using as rough numbers. I don't know anything about your finances, what you can get loans for, etc. But you could buy, like, say, a 200 grand property. You need a 40,000 deposit, and you get a 160 grand loan, and say 10 grand for stamp duty and legal costs. So for 200 grand, you'd put down $50,000 deposit, and you'd have a 160K loan, and you'd be getting, say, $350 a week in income. Yeah. If it was me and I had 500 grand, I'd go to buy 10 of those properties at 200 grand, so $2 million worth of new asset, 500 grand worth of deposit down, $1.6 million worth of loan with 3,500 a week income.
Yeah, definitely. Yeah, you got that passive income coming from all the individuals like that. I guess they're the cheaper properties.
You got 10 tenants going to work every day, earning money, coming home, giving it to you because you're being a good bloke, providing affordable accommodation to them.
That's it.
And then you could go back and then refinance. If you're buying them for 200 and they're worth 250,000, well then you've got 50 grand equity in each one. You've got $500,000 worth of equity. You can go back.
And you move on to the next one.
Buy the next 10. Yeah. That's how we see those large portfolios get built. And if it was me, I'd be looking to expand. Like, you might be able to pocket in your current position $100 a week, $200 a week, whatever it is. But like you've got such a great position there, you could go back and build yourself a new income stream, and the $200 becomes irrelevant if you're earning $1,000 extra income.
Yeah, well, that's the sort of the idea. It's sort of, for me, live a pretty simplistic lifestyle, but sort of looking to hopefully have that $2,000 a week income by the end of it, I guess. But would be more than sufficient for myself.
One property will not retire someone.
No,
2 or 3 properties won't. But if you have a larger portfolio, you've got multiple cash flow streams coming through and multiple growth streams coming through. Very, very important.
Yeah, definitely.
So
awesome.
Someone just wrote on here, Ty, buy up big tenants, pay down your debt.
That's it. I'll be happy with that.
Yeah. So
easy.
If you need help, just speak to the team, see what we can do. It sounds like you're in a terrific position. Just a matter of working out from what you can borrow, what you want the strategy to look like, etc. They're just some examples of what you could do. Everyone's position's different, and if you want to have a bit more of a chat about it, just reach out to the team and we can organise a chat. So.
Yeah, definitely. No, will do. Thanks heaps for that, mate.
Pleasure, Ty. Thanks a lot for the call. Have a good night.
You too, mate.
Cheers, mate. Bye for now. Thank you. Wow, I've talked a lot tonight. That was a bit different. I've seen here, Justin said, this is pretty cool having the Q&A. If you guys do like the Q&A, smash up the likes, leave us a comment and share us with your friends and family. That way we know that you like these videos and we can give you more of the content that you do like and less of the stuff that you don't like. But that was fun. That was very fun. So I'm glad we did it. lovely connecting to all the callers that have called in. I think that there's a few, as I've seen, like little things pop up on the screens and stuff that we haven't been able to speak to today. So yeah, with it, we'll probably do another one of these at some point in the new year. So if you guys do need help on building out a portfolio, if you need help working out what your strategy is, overcoming something, my team, I've got a very, very strong investor relations team that are mostly all investors themselves that, you can call up 1300 367 925. I think it's maybe somewhere in the description. There could be a look in the comment section or in the description of this video, and you'll find a link to have a chat with one of our team to discuss your position and see where a conversation could take you, like we've had today. So yeah, I just seen Stephen popped on. He's a part of my investor relation team and said, awesome for everyone to see what you are learning from you every day. So that's Stephen, who is on that podcast that I was talking about beforehand. So yeah, thanks, Stephen. I've got lots of more articles here. I didn't go into my crazy rants like I normally do. This like, look at all these, right? We missed out on rants today from me, right? But yeah, I think it was really cool getting to connect with you guys and girls. And yeah, thanks a lot for viewing, spending your time or your Tuesday night with us, or whenever you're watching this. And yeah, appreciate that. And if you need help with anything, click on the link wherever it is in the description. Speak to the team. As a little final message as well, because this will be my last Facebook Live for 2023. It's been a big year, I guess, for myself, for the business, for the community. We're seeing lots of people do lots of cool things. We're in a world where there's a lot of noise. Yeah, there's problems with interest rates, all that sort of stuff, but we're seeing massive rent increases, seeing lots of cool stuff that's come from that. And I guess every year, right, we've seen the last few years we've been going through lockdowns, pandemics, all those different things that you would never have thought would have ever been possible or we would have seen in our lifetimes occur. And we've seen literally property markets double and triple, and there's been some massive and amazing wins and growth out there. So yeah, thank you for everyone for entrusting myself, my team, in whether it's listening to us and applying it yourself, whether it be listening to us and wanting to come on for us to be able to help you and hold your hand along the way. Just thank you for that. Thank you for the confidence in what we do, and it's been fun this year helping you kick ass with your goals. Don't forget, there's still 2 weeks, 3 weeks into the year that we have left. Make sure you reach your goals this year. If there's something that you need from me, if you're one of my investors, I will be working over the New Year period. I do take sort of like a month, maybe 6 weeks off. So from about the middle of this month to the end of January, I'll be at my holiday house and I'll be getting a big tan. My shaved head will be sunburned. I'll be at the beach a lot. I'll be working out more, and I'll be losing a bit of this chin hopefully, and kicking off some of my goals for 2024 before we get back into the next video. But do take this time out to reflect on the year that you've had. Do take this time of the year to plan for the year that you want 2024 to look like, and make sure that you do whatever it takes to get there. And people always say it's crazy, you can't do this, you can't do that, but people are out there doing it. So yeah, I'll leave it at that. Have a great night, and we'll catch up soon, guys. Stay safe, have a good Chrissy, have a good New Year's, and there's little videos I record, and I might even pop on for a random New Year's Eve video, maybe somewhere around there. We'll catch up soon. Bye for now.